right, folks, and welcome to this training session. And the reason I'm doing this, I know that this is a hard game, and as much as possible, I really believe that we have to educate ourselves. I have to do it myself about the changing terms, the changing language, the things that happen. So I hope everybody is ready to learn something and then analyze the market, because right now I believe the market is churning, and there's a time to trade and there's a time to think. This is the thinking time, but we're about to approach Genesis, and I think that could be pretty good. Okay, so Jonathan, are you here?
Yes, Tom, I'm here.
Do you have the recorder going?
We are live on YouTube, which will record for us.
Okay, so that's what I was listening for. I didn't hear. Okay, I want everybody to think about risk today. And the reason I do is because, sometimes, we get carried away when we're talking about this trade and that trade. But the bottom line is, how are you trading and what are you doing? Past performance is not indicative of future results. In my opinion, I think the market is set up for a rally. Whether it happens today, tomorrow, or after July 4th, I think the big picture is that things are falling into place for a roaring 2025. That's what I think. I haven't changed my mind about that. Now let's talk about risk. I've said this many times over the years. I always say risk before reward. There's a lot of trades I see to do, but I don't take them because they're outside. The risk is outside my parameters. Does everybody give me a yes if they understand that statement? Sometimes the risk is too great and overcomes the opportunity that you see. Okay, that's very important to understand that point. There will be trades you have to pass upon when you're trading. Now, this is the bigger picture I've outlined. Right now, we're right on schedule. Again, we have a warning day. If you look there at the end of May, the market's going to get a little sloppy. How far can we take it up to the line? I'm not sure, but we got to stay in tune. And how do you stay in tune? I got several programs that follow the market around the clock. One, of course, is the TNT program. And if you're in TNT, you're getting the best I can give you 24 hours a day in TNT. That's the bottom line there. But market's right on track. We'll see if we got one more push inside of this week. There's my warning chart. If you look right there, the 23rd is a warning day. Wouldn't surprise me to see us make highs and then weaken from there, or we might wait the next week, but it's going to happen, I believe. You have to count on that happening in the future. Okay? That's just the way it is. We're getting close to the end. Does anybody like ice cream? Who likes ice cream? This is an example where I think the market is. Who likes ice cream? Okay. Well, you might not like ice cream, but here's the example. When you're eating a bowl of ice cream, when you get down to that last bite of ice cream, you go, man, I wish I had more. That's the way the market is right now. We wish I had a little bit more. We'll see if we get an extra spoonful. Okay. That's how I'm thinking about the market. Risk before reward is very important. Every trader must decide how much money they're willing to risk. I can't tell you to take this trade or don't take this trade. All I can do is share with you maybe what I'm doing, but maybe I'm right, maybe I'm wrong. You have to decide how much money to risk when you put money out there. I'm not just talking about one trade, but an entire strategy of trading. An entire strategy of trading. The biggest issue most traders have is they fly from the seat of their pants. They don't do the work. They just hear something and go chase it like a shiny object. That's why I use time of day, time of week, time of month to decide on risk. And that's why I use the reference bar concept. In the reference bar concept, there's an art to it. But if you learn it, you'll be better than 95%, probably 99% of everybody else out there if you learn the reference bars. We believe you must deploy capital with equal risk. In other words, equal size bets when you put money at risk. Because especially when it comes to trading options. And options seems to be the weapon of choice of most people. I like options. Let's go over a few examples. If I decided risk per trade $1,000, and I buy a $3 option, I can buy roughly about 3 options for that $1,000. Does everybody understand that? That's how $1,000 goes into a trade. 3 options for 1,000. Okay? At a price of around 3. If the option costs $2, now my number of options goes up. I can have 5 now, okay? But the dollar amount exposed is the same. That's the key part. That's the key part. Now, what if an option costs $14? You got a couple choices. You got to pass on the trade if you're only going to risk $1,000 because that'd eat up your whole 1,000. Or you could consider trading a spread alternative that does match your risk parameters. Therefore, you can reduce the cost of that option to get it inside by spreading it. That's why I like spreads. No trader knows this is what is really, this is hard to really, I would say, let me say this. It's hard to know. There's trades that I see that I go, golly, this trade's so great. Let's put all the chips on it. I used to do that. I don't do that anymore. No trader knows which trade will pay you and which will not pay you. I've been fooled. I get fooled every day. I look at something and say, oh, this is a good looking trade. And then I realize it was not good. Your odds of success across the journey of trading will increase using equal bets because you're equalizing your process by doing that. Conclusion, no trader knows that. Another insight for trading options, this is my rule. 72 hours after I do an option trade, I got a clock ticking in my head. Why? Because 72 hours makes me come to realize one key important point about trading. Options have a day decided in the future when they're worthless. That's called expiration. The 72-hour rule tells you better take action. And that's the important part, okay? That's the important part. 72 hours. So if I put on an option trade, I'm going to look at it 72 hours from now. I'll probably look at it the whole time, but I'm always wanting to follow. The only alternative to keeping something beyond 72 hours is consider a hedging technique. Like if I'm long a call, I might sell another call because my market timing's off. I do that sometimes. You have to ask what type of trade you're in, how much time is left until expiration. You don't want to do that if you got a short period of time to expiration. Maybe you believe your direction's right, but your time is off, spread it. I'm okay with that. The key is expiration date. How much time do you have for your original analysis to take hold? Let's go through an example. We buy a 519 call on the QQQ expiring in 10 days. We got an expiration date of 10 days. Instantly, I know that 30% of the time I'm going to be looking hard at this option, whether I stay or fold. I know that instantly with a 10-day option. Am I bullish? If I'm bullish on this trade, I got 10 days to go. Do I believe the market's going higher? And the answer is yes, I want to stay with the trade. But let's say the price of the option doesn't immediately turn profitable, in fact, goes against me. I still believe the trade's good. Then I might consider at this point to sell the 520 call, which mitigates my market timing by giving me another shot. And that's why I would do it. I do this all the time. Buy a 519 call thinking I'm going higher, and I find out the next 2 hours are not what I thought they were going to be. I'll go on and spread it. And my direction has at least a day or two to work out of my bad market timing. If the trade continues against you, I can exit the spread and take a loss, but the loss will be mitigated some by the hedge you took. If your directional bias ends up correct, you could break even or even profit from your down call spread because your net has been reduced, your exposure's been reduced, and in fact, you've lowered your cost of exposure by putting that hedge on. The most aggressive approach would be to buy back the short call and go outright long once that underlying trend you were playing for is in force and you got enough time to have fulfillment. I do that too. That's a very aggressive approach. And I've done that over the years. You got choices. When do they play in? And when do you say, hey, this is just a bad trade? When buying options, you want more time to expiration as a general rule. When selling options, you want as tight a time period as possible. Why is that? Why do you want more time? Because you got an option. Every day that goes by costs you money if it's not moving in your favor. It makes you money if it's just staying there. So selling options is a preferred method for a market that's sideways, for example, when selling options. This chart I saw 40 years ago. It was printed in value line. What I noticed about this is the slope of the curve. Does everybody see the last 30 days, the slope of that curve on that option expiration? That really made a change in my thinking with options. So in fact, when you get inside of 10 days, that sucker falls off a cliff. You better be right, okay? A lot of money to make doing that, but you got to understand too, you better be right. You don't have days, you got hours to be right, okay? That time decay, the old time decay. And this is something I tell people all the time. Don't trade options like you trade stocks. Stocks don't have a deadline. It's a whole different strategy. How many people have heard Wall Street say don't do short-term trading, buy long-term? How many people have said that? I heard that over the years. Avoid, short-term stuff, right? You know why they say that? Because over a 10-year period, 7 years are going to go up. Here's the problem. You run into a year like 2022 and you lose 30 to 40% of your investment in that down market. So you better have an idea where the market turns south if you go long term, or you can lose a lot of money if you come in at the wrong time. Now, options have a time limit, okay? Options have a time limit. That time limit is something that is called days to expiration. DTE. Conclusion. At the end of the day, the trader that takes equal risk and uses discipline to take losses when the market calls for it will have better odds of becoming a successful trader. That's what I want everybody to do. follow good processes when you make trades. The reason I'm taking time today to go through these basic concepts is because we just come off an unbelievable streak of trading, correct? But it doesn't change the fact we still have to follow our process. We can't get drunk on the excitement of how good we're doing. We just got to always be aware. The reason we're able to do that is because we're following a good process. And that's why I wanted to take time and do that today. It's a refresher to remind you what you got to think about when it comes to trading. We'll be back, Jonathan, to stay on schedule. What time are we coming back? 12 o'clock?
Okay, 12 o'clock, about 40 minutes from now. Sounds good.
All right, folks. Think about what we just discussed. Think about the power of what we just discussed. You will become a better investor trader following what I just said.